Hi, I'm Scott Newman. Building a balanced investment portfolio today requires different thinking. Our guests today have questioned traditional approaches to asset allocation by asking a critical question: what should a balanced fund balance? Here to elaborate on that statement are three members of Invesco's award-winning Global Asset Allocation team: Scott Wally, Chief Investment Officer, and portfolio managers Mark Onrud and Scott Hickson. This team is responsible for managing Invesco Canada's suite of Invesco Intactive portfolios. Gentlemen, thanks for joining me today.
Thanks for having us.
Gentlemen, in my intro, I talked about the idea that asking the important question, what should a balanced fund balance, has been so critical into the essence of how Intactive is designed and built. And perhaps we should start there, is really just get a good basis of how you think about portfolio management and risk management, and ultimately then how that drives the construction of the portfolio.
Sure. Well, perhaps I'll start off with an answer and would love to have Scott and Mark contribute. But really to start off with, we think about what are the main kinds of economic outcomes. Well, we've learned not just over the last 5 or 10 years, but for generations before that investors simply can't anticipate all the different environments and situations they'll face. The logical thing to do then is to make sure that you have assets that will do well in at least one of those different kinds of situations. And so we really try to think about balancing our risk exposure across different kinds of economic environments. That's very different from what you would find in a normal balanced portfolio, where, say, 60% stocks and 40% bonds. That sounds fairly balanced, but the reality is the vast majority of the risk is with stocks. And therefore, if we run into a recession or other kind of crisis, the portfolio is likely to have a really rough go of it.
The last few years have challenged, not only approaches to portfolio construction, but has challenged a lot of investors as well, to stay the course and to actually try to mitigate some of the volatility. Perhaps, Mark, you could just talk in a little more detail around the idea of how you try to achieve that balance in the portfolio.
Sure. Well, it really gets back to what Scott laid out and just having economic diversification. So that's the framework that we use in building the portfolio. So include assets in the portfolio that do well in different economic environments. So in the strategy, really both how we build it strategically as well as how we manage it tactically, we're not trying to forecast returns or what the future environment might be, but really uses a starting place a portfolio that's well balanced between those different environments. And for us, we do that by investing in developed market equities, longer-term government bonds, and commodities. So you're kind of in Boy Scout parlance, I guess we would say. You want to be prepared ahead of time, and that's really where the portfolio starts.
Scott, perhaps I'll address the next question to you. The importance of having a framework designed, a strategic framework designed for Intactive is so important around balancing that risk. But we also find ourselves in a world that is fraught with uncertainty and fast moving. And maybe you could speak for a minute about how Intactive adapts to changing conditions and potentially major market events as well.
Sure. Well, we know that over short periods of time that assets behave differently in response to what's going on in the macroeconomy. So any investment process needs to have, as a part, the ability to shift the mix of risk in the portfolio to favor those assets that tend to do well in difficult periods of time or in good periods of time. And we're no different. Our processes enables us to not just have a portfolio that's always balancing the risk across the three asset classes that we use, but take advantage of some of the changes that we see in order to increase the risk, say, of equities if we find that equities should benefit from what's going on, or in cases of stress and turmoil, increase the fixed income allocation to the portfolio.
Okay. Let's talk for a minute about those specific three economic environments. Two are fairly evident, this idea of low inflationary growth or non-inflationary growth and recession, but certainly one of them, this idea of inflation, is something we really haven't had to deal with too much for a long time. Maybe you can just address that idea and why it's important to be in a portfolio, even though we haven't seen it for an awfully long time.
Sure. Well, the simple reality is even though we haven't seen it for a long time doesn't mean we're not going to see it sometime in the future. And importantly, it's the impact that that kind of environment would have on the portfolio. So if we just take very simply assets that most investors have in their portfolio, nominal bonds, whether it's Dex Universe or others, and then equities, those are all likely to do quite poorly if we had a period of sharply rising inflation. The history of inflation on equity markets, even more resource-oriented markets like Canada, is that companies get a lower PE when inflation starts to rise dramatically than they do in more quiescent times like we have now. And so without having something in the portfolio to do well during those times, you're likely to have big drawdowns, big losses in capital just at the same time that your required expenses are rising. Now, this actually gives a great example to elaborate on something Mark talked about with what kinds of assets in the economic environment. Fixed income is probably one of the most important asset classes to really break apart and think about how they behave in different environments. So, for example, in recession, long-term government bonds do extremely well. So, for example, in the last few months, especially in May of 2012, when we had a sharp sell-off in certain equity markets, long-term government bonds did very, very well, 4 or 5% return. Now, in periods of inflation, we have real return bonds that we can look to, give us some of that real return characteristic protection against inflation. But then in periods of non-inflationary growth, we have high-yield bonds and other corporate bonds that should do well. And so saying I have an allocation of X to bonds doesn't really mean anything. You've got to really drill down into what is that underlying exposure that you have for that particular segment of the bond market, and also importantly, how much risk do I have associated with that particular segment?
So let's drill down a little more on not just the economic scenarios, but also specifically the assets inside them. Because bonds are a big part of that recessionary protection, as you spoke of, Scott. And yet bonds have been sort of on the radar screen for a number of years now for all the reasons as to why not to own them, right? They're expensive and yields are at historic lows. They clearly still play an important role in the portfolio. And Mark, perhaps you can just comment on sort of the current positioning of long-term bonds and why they're important in the portfolio.
Sure. Well, the purpose for bonds in the portfolio, as we described earlier, is to really protect in those recessionary environments or in environments where you get flight to quality. And so they're always going to play a role in the portfolio. And then the tactical process that we use allows us to make adjustments to that given the current environment. So currently within the portfolio, we're in a position where we're more neutral to government bonds in the portfolio, increasing exposure to some of the non-sovereign exposures in the portfolio like high yield. But the elimination of sovereign bonds from the portfolio is not a part of the process. There will always be a place for some sovereign debt in the portfolio, again, to defend against kind of the unexpected going forward, whether it's a event-driven or a move into a recessionary environment.
You mentioned sovereign debt, and a discussion we might not have had to have several years ago is that it's also then important to define which sovereigns we're talking about as safe havens, and we've obviously seen that landscape change dramatically as well. Perhaps you could maybe just any of you comment on sort of how that's changed over the years and why specifically to Intactive the Canadian bonds, government bonds, still make sense.
I think Canadian investors in some ways are fortunate relative to a lot of other investors around the world because their sovereign debt is more is of higher quality than that of a lot of other investors. And so when we think about the different bond markets we could use to provide that safe haven access, Canada still is high on our list of markets to use. Now that said, we do monitor all the different markets that we consider using the portfolio for how creditworthy they are. So we actually have a process where we take the 40 largest bond markets in the world and look at what their credit default swap spreads are. And as long as they're in the lowest quartile of spreads, so in other words, investors don't have to pay a lot of money to insure against default, then we're happy to own those. Again, Canada still falls in that category. But if Canada or any other market were to start to fall out of that lowest quartile of spreads, we would really consider adding a different market to the portfolio to ensure that we can have that kind of flight to quality status within that recessionary portfolio that's so important to providing the role that we seek for government bonds.
Yeah, the whole point of having them there in the first place.
Exactly. So the last thing you want to have happen is for your bonds to start behaving like Greek bonds where they sell off when equities sell off and do well when equities do well. That really does defeat the whole point.
Let's drill a little farther down into the underlying assets that we own inside of these three economic scenarios. And one that's obviously pretty topical today continues to be gold. And Scott, perhaps you can just address the current positioning for gold in the portfolio. It's an asset that makes Intactive quite unique in that we own commodities, specifically gold in the portfolio, and perhaps you can shed some light on how we're positioned today.
Commodities and gold in general are kind of interesting assets by themselves because they're so uncorrelated with the more traditional stocks and bonds that generally get included in a portfolio. So from a well-rounded portfolio perspective, they play a very important role, not only in their ability to protect against expected and unexpected inflation, but in times of stress, gold in particular is kind of the safe haven commodity asset. So it plays a very important role for us in the portfolio. We have been overweight gold for quite some time in the portfolio as a result of the monetary policy environment that we've seen around the world with the low level of real short-term interest rates. When you have an environment that's characterized by low real short-term interest rates, generally that stokes inflation fears, and gold tends to be a primary beneficiary of heightened inflation fears. So we want to have the exposure to that asset in the portfolio. Recently, we've seen some of the trend in gold, the price trend, price action in the asset has come down somewhat, but we still maintain our overweight exposure to the asset.